May 6, 2010. At 2:32 p.m., the stock market looked normal. At 2:32 p.m., it collapsed. In just 36 minutes, nearly $1 trillion vanished. Traders froze. Algorithms panicked. Some stocks dropped to 1 cent, while others shot up to $100,000 a share. It became known as the flash crash, the day Wall Street broke without warning. If you're enjoying this, subscribe Trade Tales FX, like and comment for more dramatic trading stories. By 2010, Wall Street had changed. Gone were the shouting traders in pits. In their place, algorithms. High-frequency trading, or HFT, dominated the market. Machines made thousands of trades in a second, faster than any human could blink. It brought efficiency, but also fragility. The system was now so fast, so interconnected, that one mistake could spread instantly. And on May 6, 2010, it did. That afternoon, a mutual fund quietly entered a massive order, $4.1 billion in futures contracts tied to the S&P 500. Normally, this would take hours. But automated systems dumped it all into the market at once. High-frequency traders detected it and reacted instantly. Machines began selling, other machines copied, and within seconds, the market spun into chaos. At 2:32 p.m., the crash began. Stocks plunged, futures collapsed, liquidity vanished. In minutes, the Dow Jones fell 1,000 points, the largest intraday drop in history. Billion-dollar companies were ripped apart. Accenture shares traded for 1 cent. Meanwhile, Apple briefly surged to $100,000 per share. Traders screamed, brokers froze, and millions of investors watched their accounts evaporate in seconds.
By 3:08 p.m., as suddenly as it began, the market snapped back. Prices recovered, charts reversed. In just 36 minutes, $1 trillion meltdown had come and gone. But the scars were permanent. Retail traders filed complaints. My stop loss didn't trigger. I lost my entire account in seconds. For some, the crash erased years of savings. For others, it created fortune, those quick enough to buy at the bottom, only to watch prices rebound instantly. Who was to blame? Some pointed to the mutual fund's $4.1 billion order. Others blamed high-frequency traders, algorithms chasing speed, not stability. Regulators called it a wake-up call. The SEC and CFTC launched investigations, and new rules were born. Circuit breakers, designed to stop trading when markets crash too fast. The flash crash taught traders one truth: machines now run the market. Algorithms don't panic, but they can multiply panic. One mistake becomes millions in milliseconds. For traders like us, the lesson is clear. Always protect yourself with stop losses. Never assume stability. And understand, speed is power, but also danger. The flash crash of 2010 wasn't just an accident. It was a warning. In today's markets, milliseconds matter, and the next crash could happen faster than you can blink. If you enjoyed this story, subscribe to Trade Tales FX for more dramatic stories and real Forex lessons. And don't miss our next episodes.